Welcome to the Focused Advisor Podcast, your go-to source for insights and inspiration on how to build your independent financial advisory business. In this show, you'll learn about success strategies, tools, and tactics to help you build your independent financial advisory practice into an enduring business. Join me, Ryan Ross, as I interview advisors and thought leaders across the industry. Kyril Asatur, thanks for coming on the show, man. This has been a pleasure already speaking with you.
Thanks for having me.
I know that you work in financial services, but can you give me just some background about who you are and how you got into the industry?
Yeah, absolutely. I'll give you the kind of quick summary. So my family actually immigrated here in the late 80s from the former Soviet Union, what is now the Ukraine. And as all, well, not all, but many immigrants, my parents wanted me to be a doctor. And so I was actually a pre-med student originally at NYU. And I figured out within, less than a year that I did not want to be a doctor. And this is the kind of late 90s. And if you recall what was going on in the markets, it was kind of the first internet kind of bubble that was just, beginning, and the internet was becoming a thing. And so I kind of figured out that there was this thing called the stock market, and it seemed like if you're good at math, maybe you can do really well there. And so I switched my majors, switched schools, ended up graduating with a degree in finance and banking. And I was lucky enough to get my foot in the door at Goldman Sachs right out of undergrad. And I started in an analyst program there for about 3 years, rotated through a couple of different divisions. And then the prime brokerage business at Goldman Sachs was recruiting people, and they were one of the folks that called me. And that was an interesting business because I don't know how familiar you are with the prime brokerage business, but it's primarily dealing with the hedge fund clientele of the firm. And so it basically provides kind of the financing for hedge funds and all kinds of services. So I ended up after 3 years joining the prime brokerage business, which at the time, and this is kind of the 03, 04 timeframe, the hedge fund industry was going through really a huge amount of growth, kind of post the dot-com bubble bust, because the hedge fund industry had done really well in that kind of crash. And so it was really exciting to be a part of that. I ended up on a team towards the last 2.5, 3 years of my time there that was called Capital Introductions, which is basically somewhat of a niche area where we were helping introduce our hedge fund clients to potential institutional investors. And so it was kind of a cool role because I got to meet tons and tons of hedge funds, and I got to meet tons of institutional investors. And so after about 8 years at Goldman, one of my clients, which was also founded by two ex-Goldman guys, they were looking to hire somebody to focus on the business and investor relations and marketing and business development. And so they asked me to come on board. This is early 2009, right during the financial crisis. And so I jumped kind of to the buy side, as they say, from the sell side. And then I spent the next 8 years of my career on the buy side, mostly at that one firm that I had left Goldman to join, and then subsequently was recruited into a couple of different roles. Mm-hmm. And I was always kind of on the institutional fundraising side. So basically, talking to pensions and foundations and endowments and family offices about investing in hedge funds and how hedge funds could be a portion of their portfolios. And one of the last jobs I had for the first time experienced getting the fund that I was working on onto one of the big bank platforms. And that was something new to me. I was familiar with it, but I hadn't worked in that channel, so to speak, ever before. But it opened my eyes to this whole wealth channel that I wasn't really familiar with. And so this was, call it the 2015-16 timeframe. And in that experience, I discovered that there was a whole kind of independent wealth channel, which was, basically financial advisors that maybe started at a Merrill Lynch or Morgan Stanley or Goldman Sachs and decided to start their own independent firms. And I thought that was a really, really interesting channel. So I started to do a lot of work on that part of the kind of institutional investor universe, trying to, go out to them, build relationships, understand how they're utilizing hedge funds or other alternatives. And in that experience, I kind of learned that there was not a ton of firms that were actually doing a lot in the kind of hedge fund and alternatives bucket, so to speak, for their clients. And so that eventually is what led me to start what is now Centerfin. So that was kind of the bigger picture background as to how I got to where we are today.
Why do you think? So you said that firms aren't really doing a lot of, or they aren't doing private equity or hedge fund. They aren't offering those as a service to their clients. Is that what you're saying?
So really, it's twofold, and this is obviously we're now fast forwarding 6 or 7 years from that initial kind of experience, but. Really, at the time, what I found is a lot of these firms, financial advisory firms, wealth management firms, they really do two things. They help with actual financial advice, which is, everything from planning to estate to tax, and then they manage the money, right? And in managing the money is where I found the lack of the use of alternatives. So most RIAs, as they're referred to, as you know, we're using kind of cookie cutter 60-40 approach, 60% stocks, 40% bonds. There were a few that were dipping their toes into private equity and hedge funds and private credit more recently. And it's, of course, over the last, call it 4 or 5 years, has become a big kind of focus area for for the large private equity and private credit shops, the Blackstones, TPGs, Carlyles of the world, Apollo. But when I was first thinking about it, it wasn't really a focus for any of those firms. And so I saw an opportunity to really build something where we can use our expertise and our experience and our network to create a very differentiated offering for clients and financial advisors.
Mm-hmm. So this is kind of the idea that the main function of these financial advisory firms, wealth management firms, is not specifically to find the kind of diamond in the rough. They want to manage their clients' money. They want to make sure that those clients are prepared for, any volatility that might happen in the market. Then they have a plan, right? But it sounds like what you guys discovered is that oftentimes, if the plan it includes kind of like a basic cookie cutter 60-40 equities bonds split, right? That may or may not include private equity because maybe the client doesn't qualify for it. But increasingly they are. And I also think that the equities market is, just because regulations have kind of reduced the amount of companies that want to go public, just because it's such a pain to go public these days, you still got to find investment opportunities. And to do that, you need to go into the private markets, things like that. That's what you're saying, right?
Yeah, I think that's part of it. And I think there was also this kind of misconception historically in the non-institutional world, and let's put the wealth kind of management world in that bucket, where if a financial advisor were to talk to a client about a hedge fund, it was for some reason kind of labeled as a risky product, right? Because it was this private thing. It's not something you can track on your Yahoo Finance app or anything like that. It would you get a monthly NAV or a quarterly NAV for private equity or private credit, and so it was considered to be quote unquote risky. And the truth is in all of my experience, what I came to understand is that it's actually not riskier. It's just a different kind of risk. And so if used properly in a client portfolio alongside public equities exposure and public bond exposure, public credit exposure, it's actually appropriate for a larger audience than just the kind of upper end of the client segment.
That's a really interesting way to put it, right? Because it's just a different type of risk. I was looking at your bio, and one of the things it said was that you were on a team that focused on opportunistic credit. Is that right? What does that mean? I think that kind of filters into this, like the risk mitigation strategies. But like, how did that inform your thinking?
Yeah, no, it's a great point, and I appreciate you bringing it up. So yeah, on the buy side, when I worked at various funds and with various funds, sometimes in an advisory capacity, I largely focused on credit strategies, and credit strategies are, and I'll dive into kind of opportunistic credit specifically, but generally speaking, there's two kinds of risk. There's equity risk and there's credit risk, right? And equities, you can get public equities, right? Buy stocks on the stock exchange, or you can buy private equity funds, but it's the same kind of risk, right? It's equity risk. It has arguably more upside but more downside. And then there's credit risk, which is debt instruments where you should have less upside but also less downside, right? And in the credit world, there's all sorts of part of the market where you can generate almost equity-like returns, but without the same downside as equities. And so I spent a lot of time in these kind of with these kind of strategies where as an example, buying distressed debt. Distressed debt is basically a company that took on too much debt, is now having a hard time servicing that debt. The regular holders of that debt need to sell it because they're not, they're worried about getting their money back, and they sell it at a discount to the par value, so to speak. So usually debt is issued at 100 cents on the dollar, and distressed debt funds will buy it at a significant discount to that. Mm-hmm. And so you effectively get, as an investor in a distressed strategy or an opportunistic credit strategy, you get equity-like returns, but you're taking kind of debt-like risk, so to speak.
Interesting. This reminds me of this book that I read a few years ago called Bad Paper. And it was about the non-performing loans industry, right? And this was really like guys, they're boots on the ground. They'd buy I don't know if it was called a portfolio, but it was basically a large Excel file of all these companies that either had cell phone plans or non-performing credit cards. It was unsecured debt, so it wasn't like mortgages, right? Which is probably you're gonna have not as much of a discount, but like they're buying it for 4 or 40 cents, really cheap on the dollar. And these shops would just make calls to all these people that had non-performing loans. And it sounds like the hedge funds, they come in and they buy those portfolios to see if they can capture any of the value on that margin, I think.
Yeah, no, that's exactly right. Yeah, and you can have, like you said, you can have credit card debt, auto loans, all sorts of consumer debt, but there's also tons of corporate credit debt that you can buy at a discount, right? So smaller, so ironically, a lot of private equity owned companies, the way that private equities generally works is they will buy a company with a combination of debt and equity, right? So they will lever the company up, so to speak. And if the company runs into trouble because of the economic cycle or something specific to the business, then what ends up happening is that the debt becomes stressed or distressed, and that's where some of these other financial players step in.
So where did Centerfin enter the conversation for you guys?
So Centerfin really started out with this observation that the RIA industry in general was not as far ahead in terms of the utilization of alternative investments for their clients. And so what we started with this was this idea that we can build portfolios that were more sophisticated than a typical 60-40 portfolio, but offer it to a broader audience than just the big institutions or the very, very wealthy. And so that was the kind of genesis of it. And what it evolved to was that as we dove into the industry in more and more detail and spent more and more time with folks in the industry, financial advisors and small RIAs and bigger wealth management firms, we realized that there was so many other kind of low-hanging fruit in terms of what we thought we could do better. And largely due to the fact that a lot of these firms were not utilizing technology to its best ability. And so half of my team comes from a technology background. And so when we would kind of do a deep dive on some of these service providers, whether it be custodians or, order management systems or CRMs or whatever it is, we would find that there was a huge fragmented kind of playbook out there in terms of what advisors used. And so you couldn't really piece it all together. It wasn't very seamless in terms of how the advisor's experience was. And B, a lot of advisors were just not even engaging with the technology, right? So they were kind of old school. They're still very much pen and paper. They would open up accounts, using paper files, and DocuSign became a little bit more popular during the pandemic. But believe it or not, the industry is still kind of well behind in terms of where it could be in terms of the digitization of financial services. So that's where that's kind of where we went. So we went from just the investment piece of it to a more holistic solution focused on advisors that are technology oriented, that want to deliver value to the client, that want to have a better experience, and hence their clients will have a better experience, and also have this better investment solution as part of the offering that we can bring to the table.
Yeah, so it sounds like in the past, advisors might not have considered private equity because maybe it was like an opaque asset class, but And also, even if they were interested in it, there was like almost an operational challenge to actually get the reporting into one place where it's easily accessible. So even if they had the desire, it was hard to actually look at it, right? Am I hearing you right?
Yeah, absolutely right. Yeah. So they were just not equipped. Many of these firms were not equipped with the experience of how to actually administer and operationally support this type of business. And the reporting is a good point, right? Because you're getting a statement from whoever the administrator of the fund is that you're investing in for your client, and then that doesn't show up again because it's not custodied at Charles Schwab or wherever you custody your assets, and so the reporting is not great. So there's just a lot of room for improvement there.
So is this more for the advisor that's been using private equity for a long time and they just want kind of a consolidated way to view everything, or is it for the advisor that's like, I think we need to look into this asset class, we're not seeing the returns that we want or the availability of like returns on in the private or in the public market, so we need to be incorporating this into the portfolio of what we offer, or who is it mostly for?
Yeah, so the interesting thing about it is coming from the kind of institutional investment world, we thought the investment piece was kind of the most important piece. But what we realized, again, after spending so much time with advisors and wealth management firms out there, is that there was a lot of other things that advisors did for their clients that brought a lot more value to the client than just the investment piece. And so what advisors are actually attracted us to is not just our experience with alternatives, whether it be hedge funds or private equity or private credit or anything like that. They're really attracted to us for the fact that we lead with technology. And so we have a much more streamlined process around how the advisor can work with their clients. What was an interesting learning for us early on as we started to kind of dig deep into the industry was that advisors spend about 50% of their time on non-client related stuff. And that could be compliance, operations, all sorts of, CRM functionality that like is very manual. It's not very automated. And what their most valuable time spent is actually time with their existing clients and prospecting new clients. And so what we learned is that with the utilization of technology and the way that we've approached it, we can probably decrease that 50% by 70%. And so effectively giving back the advisor about 30% of their time. And so it's super valuable to just embrace technology and take our approach and get back time that you can then go spend with existing clients and prospective clients and help grow your business and keep your clients happy. And so they're really, what the advisors that have engaged with us are really interested in is our technology first approach. And the investment piece is just as important, but we don't even lead with that these days because what we realized is that just giving the advisor more productivity and efficiency is super valuable to them.
Is there a way to or how do you communicate that difference? Is it a way to you're just saying like how much of your day is spent doing non-client stuff, or how do you communicate that kind of the challenge that they might run into?
Yeah, no, that's a great point. We actually just did this presentation where we put this data out where effectively, if you're a sole practitioner, right, and this is where we do find a lot of, and I think you spend a lot of time with folks like this, right, smaller practices where it could be one person, two people, and whatnot. They are spending roughly 50% of their time on non-client related stuff, and what we learned is that by giving them back 30% of their time, that increases their revenue by being able to service more clients by about 35%. So on average, it's $100,000 a year in extra revenue, and so it's super valuable. Not only are you able to have a better experience yourself, and your clients are having a better experience, but you're also growing your business just by working with us.
Yeah, it's an interesting point you make, that looking at it from like a yearly perspective, because if your revenue is, say you have, let's just keep it clean, $1 million a year in revenue, right? And you're working 40 hours a week, there's a very specific way that you can kind of extrapolate out the dollar amount of time that you might be spending on one aspect of your business versus another. And then you can quantify that exact amount, right? It's going to be like a testing thing, right? Because 1 week's going to be different, and maybe you'll take vacation. But I remember I was at a conference, and this guy was talking about using AI literally just for like content writing. And one article might take you 4 hours to write normally, but if that takes you 15 minutes to write normally, and if you know exactly how long that you're taking to write that, if you know your price per hour, you can extrapolate that out to say like, oh, I spend $30,000 on content creation. What if I reallocated that time to doing something different, offloaded that to somebody else that has a lower cost per hour? It's a very simple way to make it very clear, like, this is probably a better use of my time rather than having to deal with that thing that's a lower value thing according to my skill set, you know?
No, that's absolutely right, and that's a great example, and I'm glad you brought up the AI. So, as I mentioned, half my team is on the technology side, and our CTO, my co-founder in this firm, has been enthralled in the whole AI space ever since kind of ChatGPT's latest version. The one that they kind of announced in late 2022 came on the scene, and I have, by extension, also been actively using it since then. And I would say that what's really exciting is we've been using it for productivity purposes, both on the advisor side, on the management of the firm, on the technology side of the firm for a while now. But even as recently as 6 months ago, I would say that there was still limited use cases where the technology was still not great. It would still make mistakes a lot, and you wouldn't be able to use it for too many things. And then, as these models have gotten better and better, the use cases and the ability to use this technology to enhance productivity has just gotten much more wide open. And I would say, I mentioned before that there was all these service providers that these financial advisors were using, and they're very fragmented. There's literally hundreds for different things. And, within each category, there's probably dozens. And the reason why that model made sense is because, to your point, if I can use a technology in order to lower my cost, of achieving something, whether it be content writing, or how I'm managing my prospective client list in a CRM, how I'm communicating with clients, then if I pay somebody $30 a month or $100 a month or whatever to have a technology where I can do it better, you would do it every time. And what we found with these recent developments in AI is we can actually recreate and build our own solutions that will actually be better, and it's cheaper than actually buying all these disparate services. And so that's the really exciting thing about this, because it's kind of, timing is kind of an interesting thing, because even a year ago I would not have been able to say that. Today I can say that very confidently, especially since this technology is evolving at the speed it's evolving, and how much better, I don't know if how closely you follow some of these iterations of that OpenAI's put out, but every version, which is coming out every 3 to 6 months, is exponentially better. It's not marginally better, it's exponentially better. And so it's super exciting, in terms of what the future holds.
It is. There is a great example that I discovered maybe like a week and a half ago, which might as well be 10 years. But it's called, you can create your own GPT effectively. And I think they've had this around for a while, but I was speaking with a client and they're like, oh, I have to go through this compliance document all the time and find these things. And I'm like, there's definitely an easier way to do this. So what I did was I took the compliance document, I uploaded it into like a custom GPT, and I was just like asking it questions, right? Like, what page is this on, right? Which is like a glorified index. But I'm like, how can we use this to just speed up the baseline process of things that we do? And now there's just a resource that we can go and ask compliance. It's going to be an evolving document, right? Because they are at the SEC and their relationship with all the compliance departments. They got to make sure, and FINRA, right? They got to make sure that they're dynamic to that. But it's as simple as just uploading that document into the GPT and then just saying like, what are the updates here, right? It's so interesting.
Yeah, no, it's the potential is huge. I would say the fact that, obviously it's a highly regulated industry, so you have to be very careful in terms of how you use data, especially, any kind of PII or anything like that. You can't obviously share it with, non-proprietary data sources or data providers. But what's interesting, to my point about how it's evolved is that, just in the last 6 months, there's been this, I think, and we're still kind of figuring I really think of this as like the early days of the internet, because, in the early days of the internet, we were still kind of figuring out, how do you use this thing, right? Like, what's the point of all of this? Because, you basically are replicating what we did in the physical world online. Yeah. And here, where it's a little bit different in that we're utilizing this, it's almost like a, it's really a productivity tool, but like, how do we use it most effectively? And what's interesting is that you don't need these massive models for most of these use cases. So to your point about content generation, that you can have, an off-the-shelf model that you can take that's not a massive model like ChatGPT. You don't have to pay for it. It's open source, and you can take it and you put it in your environment, and then you use it for these specific use cases, right? And so effectively, what we're iterating on is this kind of, really virtual assistant that you will be able to speak to or, type to, whatever your preference is, about, helping you throughout your day to day, right? So that's kind of what we envision is this, this tool where, you come in every day, you have a very dynamic kind of task list of things. Most people start their days with, like, they have some sort of checklist, right? They have to do certain things throughout the day. They have certain client meetings on the calendar. So these AI tools can automate that, and also just make the user that much more productive, right? Because instead of, like, let's say, just as like a simple example, you have a client whose birthday is coming up, right? And instead of you having to put a reminder on your calendar, hey, so-and-so's birthday, you have to shoot him a note, maybe shoot him a present, whatever, the AI will already do that for you, right? And so it'll prompt you that, hey, so-and-so's birthday is here, do you want me to send him or her, an email? And then all you have to do is say yes. It will draft it. You have to approve it, and then you send it, and it's as easy as that.
Is that built into Centerfin, or is that a separate thing?
Yeah, it's so we have some prototypes that do stuff like that. We have not fully implemented it yet, but yes, this is exactly what we're working on, is these kind of tools where even, like, it can, to my point about CRMs, right? CRMs take notes, and these days you can take notes, obviously, with these AI tools, right? So you don't have to actually physically take notes and then transfer them to your CRM, but you can take notes, and then the AI can kind of take out of that what is important. So, for instance, another example, in your client conversation, they mentioned that their son just got into college and they're going to this school, right? Again, you have to train the AI to do this, but this is not hard. The AI can, recognize that, and recognize that maybe you should send, when they're going to drop them off in college, maybe you should send them a gift certificate to, like, a local restaurant so they can go out to dinner as as just a gesture. And so these are all the kind of things. And by the way, like, right now it's at the state where we still have to kind of teach it these things. I think in time it will start to have the ability to actually be able to generate some of these ideas itself. So it's really cool.
Yeah. So what's your guys' team look like? It's you. I think you said you have, like, technical co-founders. What's the team look like?
Yeah, so me, my co-founder, Dennis, so we've been at this since the beginning. We have a bunch of people on the technology side. We have a CIO who I've known from the hedge fund industry for 15 years. And then our advisors are, we're literally, so we started recruiting these advisors at the beginning of this year. So we have 3 on board today, and we have, dozens in the pipeline. But the advisors come from all over the place in terms of geography. So we have people in New Mexico, in Oregon, in Connecticut, and we have people that are in the pipeline from Florida and Pennsylvania.
So the advisors are the users, like the end clients, the prototype clients, right? They're not like advisors to the business, correct?
No. The financial advisors. Yeah,
okay,
exactly.
Okay.
Yeah. So what we found is that we can actually, if we find the right advisors, we can offer them a better solution to what exists out there. Again, giving them back their time, giving them these technology tools to make them more productive. In return, they get to service their clients better. we have an economic arrangement, obviously, where there's a fee sharing split that goes on that we think is very attractive. But yes, it's the advisors that we are actually actively recruiting. They have their own clients, and like I said before, most of the advisors that have come on board or are in the process of coming on board are sub $100 million. Either solopreneurs or small teams of 2 partners, and they're sitting independently. They're not part of a bigger platform. Maybe they were before, but they decided to leave because the big platforms, as you know, they take a very very hefty revenue split from these advisors. So they left to set up their own shop. They have a decent kind of stable core book of business, their clients. And they're finding they're spending all this time on all this stuff that they didn't expect to be spending it on. And so what we can offer them is that productivity, get their time back. They can use our technology. They can use our investment portfolios to the extent they want to. It's not appropriate for everybody, but we do think we have a superior offering out there that's differentiated. And the other thing that's really important is that what we're trying to build is a very collaborative environment where, as you know about this industry, it tends to be very, competitive and fragmented. Every advisor kind of has their clients. They don't want to let anybody else near their clients and whatnot. We are trying to instill this culture of collaboration across the advisors, because every advisor is going to service as a certain clientele based on what their business looks like. So we have one person whose practice is largely focused on physicians and healthcare professionals. We have another person who's largely focused on business owners, right? But there's a lot of potential synergies between those 2 people. And in the old way of doing things, those were not really embraced. And what we're trying to do is to, put these people on the phone. They get to know each other. They might have no connection, before this with each other, but now they're on the same team effectively. And if there's synergies, if there's questions that come up with a client that they have, a new client or a prospect, and they can ask the question of another advisor or, of the firm's leadership, that is all very encouraged. And I think that is something, from our conversations, that's something that's not, widely practiced in the industry today.
Yeah, I think it's a really important point. The fact that, the first thing is, if the advisors have a specific target market that they're going for, then it aids in the collaborative environment, right? Like you said, if one advisor is going after only physicians, another is going only after tech CEOs, they can collaborate, they can share ideas, and they can also give you feedback, right, to figure out how to make the product better, the service better, so that you can offer this to more advisors that have different niches. But I really think that niching down, it's important for advisors, because then it helps them hone in on one of the biggest challenges that my specific market has. And then you don't have to worry. Then you can share ideas with other advisors, right? Because who knows, maybe in 5-10 years, there could be merger possibilities or acquisition possibilities. You never know. But I really think the idea of niching down is so important, just from like a headspace thing too, but also because it does allow you to not want to hold back and give ideas to people. I think because that just best practices always lift a ships rise all something about the ocean and rising ships.
Yeah. The rising tide, rising tide floats all boats, right?
Yeah.
No, 100%. I think it's very important. And you hit on something else that's really important, is we are very much focused on working with the advisors hand in hand when it comes to the technology offering. And so all of these things that I talked about, and there's tons more behind that, are all being done collaboratively with the advisors. We basically went through, we've had conversations with hundreds of advisors, and effectively what we ask them is like, what are your pain points? Like, what's the, tell us about your day, tell us about your practice, and like, what's the most annoying thing that you have to deal with that you don't want to have to deal with, right? And then after doing enough of these interviews and conversations, you start to pick up on some common areas. And like, the easiest one, and the one that most people complain about, is like client onboarding. Like, it's still, in this day and age, it's still for a lot of firms a fairly manual process. And we have a completely digital process that we already built that takes 3 minutes to open up a new account and onboard a client, versus having to fill out huge 60-page document and have your client DocuSign and all this stuff. We could just make all these things a lot easier, and make the user experience both for the advisor and the end client that much better. So. Yeah. But working with the advisor and being really focused on the advisor as the client is an important distinction as well.
Yeah. How are you finding them, or how are they finding you?
So it's been largely word of mouth networking for the last year and change. Our pipeline is in the, it's probably 75 today, and it's largely around talking to one advisor, asking for referrals to others, talking to our network and getting referrals. Pretty much everybody I know, and this is how we kind of got started in this. When we started to educate ourselves on the space, I went out to my network, and I said, listen, do you know any financial advisors I can talk to? And everybody knows a financial advisor, whether they're working with them or not. They know financial advisors. Somebody in your sphere of influence is a financial advisor. And so I would get my early introductions that way. And from there, it grew through, advisors would refer me to other advisors, and they would think what we're doing is really cool, but they wouldn't be able to really, move at this point. So they would introduce us to others. And so it's been very organic, but we're also in the process of onboarding somebody right now that, hopefully we get this done by the end of the year, but somebody who has experience as both a financial advisor and in enterprise tech sales, and his whole focus once he's on board is going to be on a more systematic way to target these advisors, find the right fit, and get them on board.
Yeah, and when you go after advisors, or who is like the main, who would be the best, who would this be most appropriate for? Would it be the guys that are working at a wirehouse, or independents, or what?
So it's mostly independents right now. So it's a lot of, our early success has been with, I described it before, but, somebody who might have been at a wirehouse and already left, or might have been at a big wealth management firm and decided to leave and took their clients and set up their own shop, kind of hung their shingle, and they're maybe a year or two into it. And they've learned, just an experience that, they're spending a lot of time on all this other stuff that they weren't expecting to spend their time on. And so those are really, I think, great fits for us. It has to be also the right fit from a personality perspective. They have to be a fiduciary. They have to be really client focused, and they have to embrace technology. So those are all the boxes that we need to check. But that's kind of the profile that has worked for us. But we're talking to people at bigger, with bigger books at bigger shops that are looking to leave. We're talking to people at wirehouses. It's all over the place.
Mm-hmm. That makes a lot of sense. Are you guys going to, I think I maybe asked you this before, but are you guys going to any conferences, or how do you kind of get a pulse on what the advisory industry looks like?
So we have not hit the conference circuit yet, but that's something that is on our kind of to-do list for later this year and early next year. But it's been, again, it's been a lot of like hand-to-hand combat, lots of networking, lots of meeting with advisors kind of face-to-face, where we can, and obviously virtually where we can't. Yeah. But yeah, it's just been a lot of conversations, understanding their business, really trying to dig into, who would be a good fit, and there's some advisors that have great businesses, but they're just not a good fit for us. Yeah. So really being disciplined about that is important.
Yeah. So you came from kind of the institutional investing world, and these guys are more on the retail investing world to an extent. Is there anything that surprised you about what you've learned about the industry over the last few years?
Yeah, I mean, I would say, like we started out talking, I think there's been this misconception around, my former world where I came from, the hedge fund industry, or the private funds industry in general, private equity, is that these are like riskier offerings. And the truth is that what I've been educating these advisors on is that they're not necessarily riskier. It's a different kind of risk. And if it's incorporated appropriately into a holistic client portfolio, it actually increases the quality of the return. It's not meant to increase the the absolute number of the return. It's meant to increase the quality of the return. So, generally speaking, you're getting, better or, same amount of return while taking less risk is the goal.
What's the you said it's a different risk. Well, maybe it's the quality of the risk. How do you qualify something? If we could I'm curious about that, and we're a little bit out of time, but I'm curious about how you would qualify one risk versus another.
So it depends on where your return is coming from, right? So if you're a hedge fund and you have, but your strategy is you buy, 10 of your, best idea stocks, you're going to have a fair amount of correlation to the stock market, whether you like it or not. You might be a great stock picker, but you have a lot of equity risk. And that's just it's going to be hard to make that seem like it's a good part of a portfolio that has a lot of more traditional public equity risk, let's say. But if it's a strategy that let's say, going back to my example about distressed debt, if it's a strategy that derives its return from buying deeply discounted distressed debt, and then generating returns on the back of the turnarounds of those companies or the liquidations of those companies or whatever, the restructurings of those companies, whatever it might be, that's not correlated to what's going on in the stock market. There might be some correlation, but it's not the same as if you were just building a portfolio like as a stock picker, right? And so that's an example. We have a systematic global macro manager that has no correlation to stocks or bonds, that largely derives its return from things like FX and rates, which are again not would take a long time to get into the intricacies of that strategy, and I wouldn't do it justice, to be honest. But they have a long track record of generating returns that are not correlated with stocks and bonds. And so that's when incorporated into a portfolio of stocks and bonds, that's what I'm talking about in terms of generating a better risk profile than just having that 60-40 portfolio.
Yeah. Well, I want to talk about you really quickly, and I know you live in New York City, so I have some this or that questions for you. Well, maybe These are just like, what do you prefer? Because I lived in New York for a little while. Are you a bagel guy?
Oh, my God. So I don't know if we touched on this on our pre-call, but my family, when we moved here from the Soviet Union, actually got into the bagel business. So yes, I'm a big bagel guy.
What's your favorite bagel?
So I can't. I mean, somebody was asking me this the other day. I mean, my parents, my father's business, out in Long Island is my favorite. It's called Bagel Plaza. It's my favorite bagel store still. I mean, I live on the Upper West Side. And I
haven't heard of that.
Yeah, it's.
I've heard of Brooklyn Bagel, which is ironically not in Brooklyn. Essa Bagel. It's funny. My thumbs up just triggered the system to give a thumbs up. So Brooklyn Bagel, Essa Bagel. I haven't heard of Bagel Plaza, but it sounds like it's worth a trip.
Absolutely. Yeah.
Bagel Plaza. Okay, pizza. What's your favorite pizza in New York City?
I'd probably still go with Motorino.
Motorino.
I have a soft spot for it. So Motorino is this Neapolitan pizza place that used to have one little spot in the East Village. And when my wife and I were still young, before kids, and we were trying to get pregnant, that would be like our weekend, Saturday, afternoon kind of. We would, go down to the East Village and have lunch there. And now they have one on the Upper West Side, so we go there all the time.
Kyril, this has been a huge pleasure. I learned a lot about your guys' company, your story, and I think it's a really cool value add for the advisory industry. So thank you for coming on the podcast, and we will get this out to as many people as possible.